Today we are going to start discussing on the deduction rules in computing the income sources. So, we can remember the first day we discussed the transitional provisions and the chargeability of income tax along with the computation rule, the calculation of income tax liability. The previous day, that is second day, we discussed the income sources chargeable with income tax. So, today we are going to discuss in calculating the income sources. As you know, what we are calculating for the purpose of taxable income is assessable income from each source. So, assessable income means the income sources are referred to in section 5, 6, 7 and 8 subject to the exemptions less the deductible expenses. So, we have done already the income source which are chargeable with income taxes along with the exemptions available, but today we will look at the calculation part of it, that is the income source subject to exclusions, then thereafter you must claim certain expenses in computing the income sources. So, as I discussed, so we are mainly focusing in the strategic level the company taxation. So, therefore, I have not done the employment income because that is a relevant only for individual tax. So, therefore, even when discussed with the company taxation, the relevant income sources are the business income and the investment income. So, mainly in calculating the business income and investment income, what are the expenses you can claim against those income sources are going to be discussed today. Okay. So, you will always look at the where we stand. I think today also you must be having a act with you. We will start discussing one by one. So, in deduction rules in calculating the income source, I can summarize. First, the deductions not allowed, that we normally call disallowable expenditure in computing the income source. The section 10 deals with the expenses which are not allowable in computing the income source. Then when we come to main deduction rules, we can broadly divide it into two categories. The main deduction rule, that is section 11 of the act, then section 12 to section 19 we have a specific deduction rules. Wherever the specific deduction rules are not applicable, the main deduction rule have to be applied and see whether you can claim those expenses or not. Then section 24 deals with the reversal of amount including the claim of bad debts. So, as we discussed the previous day, our income source, especially the business income, should be taxable on accrual basis, that is whether you are received or not, the income should be taken into calculation. Similarly, with the expenses are paid or not, the expense payable you can claim for tax purposes. So, you have to apply the accrual basis. When you go to apply the accrual basis, there may be subsequent reversals. For example, if you have not received the income actually, you declare the income on receivable basis, but subsequently you are not received, and any of the reversals could be adjustable based on the provision of section 24. Finally, the sixth schedule, that is a temporary concession. There are certain deductions applicable based on temporary concession also. So, that point I will explain one by one. Okay? We will proceed now. Deductions not allowed, that is, if you summarize, the section 10(1)(b). With the section 10(1)(a) is to say the no deduction shall be allowed against the employment income. Since you have not discussed the employment income for corporate tax, I left out that one. So, look at the section 10(1)(b), that is basically there are certain disallowable expenses are given in relation to calculation of any income source. The first one, domestic expenditure. Section 197 clarify what the domestic expenses are. So, domestic means basically personal nature, no? But you can't take as it is because the definition follow under section 197. Though our interpretation section is 195, there is a dedicated section under 97 to clarify the meaning of domestic expense. So, that means so important the definition of domestic expenses. If we summarize the definition of domestic expenses are given under section 197, there are three categories basically. I think again first one is not so important because it says the individual incur an expense in respect of himself to the extent as it is provided in the law. So, the item 1 of the definition is basically for a proprietorship business or individual business. It says if individual incur expenses for is on his own for himself, those expenses are domestic expenses. So, that is basically relevant for a individual taxation. So, item 2, where another person incurs expenditure in making a person to or providing any other benefit to an individual, this is applicable. There will be some other person, for example, company. The company if I incur expenses in relation to an individual, the individual could be either employee or somebody else. So, the item 2 is relevant for the company tax. But the expense incurred is by the company, but it is in relation to employee or any other individual. The expenditure shall be domestic expenses except to the extent that. I mean, if what I try to say here is all the expense incurred by the company in relation to individual is a domestic expense for his benefit, unless the expense comes under one of this category A, B and C. So, expenses are identifiable under A, B and C which are not domestic expenses. Okay? But if expenses are incurred by the company for the benefit of an individual, if that expenses are not identifiable under A, B and C, then that expense become a domestic expenses. So, as a result you have to disallow under section 10(1)(b). Okay. But I think could be allowable except to the extent that the payment or benefit shall be included in calculating the income of the individual. Thereby, if a company incur expenses in relation to benefit of an individual, such expenses are only taken into account in individual's tax calculation as his income, then there is no problem. And also I think there is a logically there is no revenue loss to the government, no? Why? Company try to claim the deduction, the same amount will be taxed in the hands of individual, then no tax benefit or loss to the government. So, that expense may be not a domestic expense. Secondly, B, the individual provides the consideration of an equal market value for the payment or benefit. So, that is basically the company incurring expenses for the benefit of the individual. So, individual concern again giving us same provides a consideration for to the extent of market value of the particular payment. There is a value for the payment. So, again that is not a domestic expenses. Third, the amount of the expenditure is so small as to make it unreasonable or administratively impractical to account for it. That is basically, if a company incur expense for the benefit of the individual, so we are not tax the individual not for anything else, because it is not practical to tax. The quantification, the benefits are not so practical. I can give a good example. So, good example is, if you go to section 5, subsection 3, some exclusion in the calculation of employment income. Yeah, one of the provision says some benefits are given to all the employees commonly. If it is not practical to quantify the benefit, because of the amount of the benefit is small in size and not so frequent, it is not practical to quantify the benefit in the hands of employee, then that is not employment income. So, that sort of a thing, even a company incur expenses, even though employee has not been taxed, because it is not practical to tax. As a result of that, what the law says here is, it is not a domestic expenditure. So, therefore, it is very simple. So, every expense incurred by the company for the benefit of individual could be a domestic expenditure unless it comes under one of these category A, B, O, C. Okay. The item 3. So, that expenses shall include interest incurred by the person in borrowing the money for the relevant expenditure. So, in other words, the borrowing cost also, interest cost in incurring the, if you have taken the money loan to incur the domestic expenses, borrow the money for incur the domestic expenses, the borrowing cost also become part of the domestic expenses. Okay. And in relation to this, I would like to give a sort of a regulation issued by the Commission General in relation to the PAY calculation. You can go through that one in the website of the tax department. It says, according to the regulation, trying to tax the non-cash benefit regulation, taxation of non-cash benefit, where the valuation method of the share benefit, housing benefit, and the vehicle benefits, the quantification is given. How do you quantify the non-cash benefit? It is not gazetted that, but it is a regulation issued by the Commission General. So, according to the regulation, if a employer given a housing benefit to an employee, how do you quantify the value of the benefit is given. Similarly, where employer provided the vehicle benefit to an employee, how do you quantify the vehicle benefit also given. So, what is trying to say, this regulation, the same regulation we look at the down the line. It says, but the expenditure incurred by the company is greater than the value of the benefit to be taken up for an employee's taxation, then there is overclaim. The company trying to claim more than the amount taxable in the hands of employee. So, excess become domestic expenses for the purpose of section 10. Okay. So, we have worked out the examples, we will look at one by one. For example, let us say if a company going to incur expenses of, let us say 1 million rupees in providing a house, the non-cash benefit in the hands of employee, let us say we are going to tax 600,000. So, company trying to claim 1 million, the employee has been taxed 600,000. So, the benefit better, the difference of 400,000 better you tax disallow as a domestic expenses. Okay. Then tax payable under the act also not a allowable deduction. So, as you know what we are doing now, we are in the process of calculating the income source liable for income tax. in calculating the income source, if you already deducted, basically say let's say business income calculation, the income tax liability, if you deducted already in the income statement, what we do? We can't claim this under this law. The income tax should be disallowed in calculating the business income. There what we normally do is we don't disallow. If you take the net profit before tax, that is enough, no? But if you have taken the net profit after tax, then what you do? You must go and add back the income tax payable under the act. Okay. The number third disallowable item is interest, penalties and fines payable to the government or political substitution for the government for breach of written law. So, basically when you are paying any interest, penalty or fines to the government and in political subdivision for breach of law, that expenses are not allowable. So, the intention is very clear. These are not a legal expense, no. So, these expenses are incurred for non-compliance of law because of breach of law. When you pay this expense if you incur due to breach of law payable to the government, so if you are going to allow that one, that means something trying to say we are trying to encourage that sort of a thing, no. So, it is not incurred the production of income my side, but nevertheless, so section 10(1)(b) clearly specified this expense you can't claim for income tax purposes. Okay. So, like income tax penalties, surcharge on EPF, EDF, no, fines on the customs made by the customs, penalty paid to the customs and any other government body, you can cite as examples for this particular item. So, number 4 is very important. The expenditure to the extent it is deriving exempt income of final withholding payment. That is to say, as you know, when we discussed the previous day, third schedule, there are certain items are exempt from income tax, no. So, as we discussed, if items are exempt from income tax, that is removed from the calculation of income source. For example, if you go to section 6, subsection 3, any income, exempt income from business should be removed in the calculation of the business income. Since the exempt income is not going to be taxed, if an expense are incurred in getting that particular income, that also to be disallowed. But make sure that it is attributable expense, not a common expense. You can't claim on a or you can't disallow on a proportionate basis, those are not in the law. Therefore, if the examination paper, the examiner might indicate sometime giving a list of the expenses, these are attributable to the exempt items, then you have to go and add back under this particular section. Similarly, the final withholding payment. The final withholding payment also taxable not under part of taxable income on a separate component, no. The final withholding payment also should be removed in calculating the income source and each and every source of income that we discussed last day. Since the final withholding payment is not going to be a part of income source, if an expense are incurred in relation to that, that expense should be disallowable. For example, the dividend income in the hands of company is a final withholding payment, no. So, in that case, if an expense are incurred in deriving the dividend income, of course, dividend income is a passive income, hardly there can be expense, but nevertheless, if the examiner identifies certain expenses are related to the dividend income of the company, then what we do? Since we are removing the dividend income as a final taxation source or final withholding payment, the corresponding expense should be disallowable under this particular section. Okay. Next, retirement contribution also should be disallowable. When retirement contribution, good example I can say contribution to the provident fund, good example, or pension fund. The contribution is normally allowed, but the section says it is not allowable unless they are included the contribution in calculating the income source of the employee, or the contribution is approved by the Commission General. Therefore, the disallowable part is applicable only if it is not coming under the income source of an employee, or if it is not approved by the Commission General. But as you know, a lot of contribution to the provident fund, if it is approved by the Commission General, so no doubt you can claim the deduction, okay, including the pension fund. There is normally in examination what we do is, if there is a contribution to provident fund, if the exam paper is silent, we can make an assumption to say, assume the fund is approved by the Commission General, therefore deductible expense, okay. That is a matter, we can make a note on that, okay, taking your position to allow. If the fund is unapproved or not taken into account in calculating the income of the employee, then under this section that contribution should be disallowable, okay. Item 6, the dividends also not allowable deduction in computing the income source. I think obviously you might wonder why dividend is said here, no? The dividend is not expense actually. When you are paying a dividend to the shareholder by the company, the dividend is actually not expense, is a distribution of income to the shareholders, no? That is the reason normally you do not charge to the income statement the dividend. The dividend is transferred to the reserve after net profit before tax. It is not expenditure. The question about disallowable does not apply. But nevertheless, you do not allow that deduction. It is not allowable deduction. So, what is the purpose of this? But look at the previous set, there is nothing like this. So, then you may wonder, see, the dividends are not a disallowable item under the previous, I am going to allow it under previous set. No, it is not the case. But you must know, look at the structure of the previous set and the current act is completely different. Okay. So, you must read the current act, the new act in that mindset, knowing the background of the act. It is completely different version, you see. Principle versus completely different. So, another reason would have been to indicate the dividends are not allowable item is, though it is obvious, one can take up the argument for the sake of argument. See, the dividend is taxable in the hands of shareholder under section 61. We will discuss 61 later on, section 61. It says, when a company distributes the dividend to the shareholder, the dividend shall be taxable separately in the hands of shareholder. So, one can take up argument, since the dividend payment is income to the shareholder, then why can't claim that amount from the company's point of view, no? Because look at the domestic expenses, it says, if the expenses are incurred for the benefit of an individual, it's a domestic expense to be disallowable unless it is taxed in the hands of employee concern or individual concern. So, one can take up the argument, if employees are going to be taxed or individuals going to be taxed, I am going to allow it. Yes, not a domestic expense. But same argument if we can put up here, since the shareholders are taxable on the dividend income, why can't we allow from the point of company as expenditure? No, that argument is not valid now. Why? Because section 10.1b say, though you are taxing the shareholder, you can't claim that expense in the hands of company because it is a distribution, not the expenditure. Okay. So, that argument is not valid now. Outlays or expenses for entertainment. It's very important. That was there in the previous set also. The moment when you look at the word entertainment, even tax authority also said to disallow, no? Very straightforward. The entertainment expenses are not a deductible expense for tax purposes. But under the previous set, There was no definition given for the term entertainment. Therefore, you take your normal meaning. That is to say, the basic requirement is not entertainment, no. For example, if you are going to give a basic requirement, basic free meals, refreshment to the employee, it's a basic requirement. It's a staff welfare, it's not entertainment. But if you are spending some money for entertaining your staff, though it's a staff welfare, it's entertainment nature, it should be disallowable under the previous act. Because you have to honor the specific rule. Therefore, here also, though it's staff welfare, but if it is entertainment nature, you can't claim it to be disallowed. Similarly, customers also same. If you are going to entertain the client, though it's for the business promotion, the business promotions are not specifically mentioned under the law as allowable deduction, unless you claim under main deduction rule, section 11. We will discuss after this. But entertainment, if it is an entertainment nature, you have to honor the specific rule, you have to go and disallow. But the point here is, the entertainment expenses are defined in the exhaustive definition. To say, under section 195, the interpretation section, the entertainment means the provision to any person of any food, beverages, tobacco, accommodation, amusement, recreation or hospitality of any kind. So, it is a very broad definition. It is a very, I do not know whether it is a very, when you say food, even the basic food looks like entertainment, no? I think there are 11 amendment required. So, whether it does not say whether in the nature of entertainment or basic requirement, no? I believe there should be some amendment required in the law to modify the definition for the entertainment. Anyway, an amount transferred in financial statements to a reserve or provision for the expenditure or losses not yet incurred but expected to be incurred in the future. This is basically what is going to deduct, it is amount transferred to the reserve or provision. For example, you chart the income statement and credit to either to the revenue reserve or any other reserve or provision account. Why you are crediting to the reserve or provision account? Because it is not yet incurred, actually not payable, not incurred, but expected to be incurred in the future. There is a basic estimation. You are making a provision based on estimation. For example, the depreciation provision, can you claim accounting depreciation? You can't say because you are claiming capital answer you can't claim. No, that is not the reason. One can argue, maybe an absurd argument. On top of the accounting depreciation, I am going to claim the capital answers also. Where the section to disallow the accounting depreciation? Yeah, this is the section. And also the bad debts provisions, the gratuity provisions, provision for repair expenditure, provision for bonus. I have seen certain people, certain company, without taking as a bonus payable or bonus payment, they narrate in the accounts provision of bonus. When it's a provision, you can't claim. It's not actual expenditure. So then the Illinois department might ask you to disallow that provision and claim only at the time of payment. No? But if you can quantify the amount of bonus payable, better you say the bonus payable, not the provision. Okay? It's very important in the wording in the accounts. So the provision is not a deductible expense, because the provision is not, by nature, the provision is not actual expense incurred. That is the point. Okay? So, amount incurred on lottery betting or gambling. So, obviously there is a good reason here because these are final withholding payment. So, relevant expenses you can't claim. The final item under section 10(1)(b) is the taxes or levied specified by the Commission General. So, we already discussed the income tax payable under the Act is not allowable deduction. What about the other taxes like the value added tax, nation building tax, economic service charge, you got a value added tax, the normal VAT and the VAT on financial services, NBT normal NBT, the NBT on financial services. So, these expenses are incurred normally by businesses. So, which are charged to the income statement, some items, but some items not. Suppose some expenses are charged, these taxes are charged to the income statement, then the question comes whether the expense, whether these items charged would be a deductible expenditure in calculating the income source. So, the answer is, yeah, the expenses are disallowable if it is specified by the Commission General in the Gazette. So, go to this particular Gazette, I would like you to go through the Gazette, it is already downloaded. Go to the Gazette, if you look at the Gazette, I think what is prescribed tax or levy is the value added tax to the financial services that is applicable for the bank and financial institution. No, for them when you are paying a VAT, it's not output tax basis you are paying VAT. On the profit calculation, on profit base you tax, charge to the P&L account. Nation building tax and financial services are the example. Economic service charge when you charge to the P&L account are the example. So, these expenses which charge to the P&L account should be disallowable item. Okay. Normally, economic service charge, what will happen when you pay, there is a time frame until a certain you can carry forward to set off against the income tax liability. After the period is over, you observe it to the P&L account as a charge to the income statement. Whether you charge in the first year or after the recovery period is over, the moment when you charge the economic service charge into an income statement, remember under this provision, it is not allowable deduction for tax. Okay. So, this only item is very good act, you see only 10 specific deduction or disallowable item. Look at the previous act, there are so much of disallowable item under section 25, not 25, section 26, I am sorry. 25 is about allowable deduction, 26 disallowable expenditure under the previous act. Section 26 tells you so many items to be disallowed, like a management expenses, foreign travelling, some part, which are essentially incurred for the production of income, but law had to be, according to the law, the items had to be disallowed, certain element, but those are not mentioned here. Okay. So, the current act to a certain extent very fair treatment. What are the business nature expenses are allowable. So, we look at the item 10, the list, I think there is no unwanted expenses to be disallowed. What is disallowable is a genuinely to be disallowable item, nothing more than that, you see. The section 10 subsection 2, it is very important section, I would say. You know, there are 3 sections, section 83, 84, 85 for withholding taxes. Section 83 about the PAY tax, 84 investment returns, 85 service fee and contract payments. But at the moment these are not in operation because of the paper notices, but not in the law. So, that is not enacted. I am discussing this particular course on the basis that there is no amendment yet. Actually, there is no amendment. So, the 83, 84, 85 we have withholding taxes. So, these are certain expenses when you are incurring, the company has to withhold the tax as a withholding agent and remit the money to the Department of Inland Revenue. So, what he is trying to say here is, if a company incurring expenses which is subject to withholding tax under one of this section, the deduction shall not be allowed for the expenditure unless you properly withheld the tax and remitted the money to the Department of Inland Revenue. That means short, if you are not properly comply with the withholding tax provision for the expenditure, then the whole expense will be a distributable item. Good example, let us say the payment of rent is investment return. When a company paying a rent to have a showroom, let us say 1 million rupees. The section 84 requires you to withhold the tax at 10% and remit to the department. You pay then to the landlord only 900,000. But you charge the income statement 1 million. Why? Because your expense is 1 million rent. But you disperse 900,000 to the landlord, 100,000 on behalf of landlord to the Department of Inland Revenue for him to claim as a tax credit. So, the cost is actually 1 million. What I am trying to say is here, if you do not comply with withholding tax provision, without deducting 10%, if you pay the whole amount to the landlord, the entire 1 million, the whole expense should be a distributable item. Then what will happen? Consequence. So, tax rate, let us say 28%, when you add back the 1 million, you have to pay 280,000 tax at 28%. So, much better in that case, if a landlord does not allow you to withhold the tax, to bear by the company itself. Why? Because you are otherwise what will happen? You have to pay additional tax. The purpose of this section is very clear. It is a good thing in order to encourage the withholding tax compliance. Okay. This is one side is a penal provision. The immediate consequence for the taxpayer is what? If you do not comply with withholding tax provision, apart from the non-compliance of withholding tax, the entire expenses also will be a distributable item under section 10 subsection 2. Okay. It is very important, section 10 subsection 3. No deduction for the expenditure unless deduction is expressly permitted in the act. I think I should tell you, the new act is somewhat different from the previous act, you see. I give an example. Let us say if we come across one expenditure, let us say, for example, expenditure of a advertisement. You find the act, advertisements are not disallowed in the act. If it is not disallowed, does not mean you can claim. For you to deduct an expenditures, there must be an express provision in the act. Then in other words, the expense should be expressly permitted in the act. You can argue, I am allowing the deduction because not disallowed in the law now. For each and every expense for you to allow it, you must find out the express provision, expressly permitted in the law. That means very clear provision under what section you are allowing. For example, if you look at the advertisement expenses, if you are going to allow it, the SL will ask under what section you are allowing. You must say, I am allowing under section 11. This section 11 says the expense incurred the production of income, you can claim. So, under what section only you are allowing. But if you can't explain under what provision you are allowing, then under this section, the assessor can take up the argument, since this expense is not expressly permitted in the law, such expense should be disallowable item. Okay. Therefore, one have to say in that case in our tax computation, even in practice when you are doing, whether you are mentioning a section or not, in each and every item to be deductible in against the profit, you have to, you must be in a explainable position under what provision you are allowing these items. Okay. So, the important rule here. Most specific rule shall be applied in case of more than one deduction applies. That is basically principle in not in taxation, even the law. If there are two different provisions which are contradictory to each other, the question comes, which rule shall be applied? No. So, they are basically the rule of interpretation will come into place. You have to apply the one which are more specific, and also you must concern the new amendment always supersede the previous one, subject to that. Okay. For example, I can give one side under allowable deduction, we will come across this particular situation where, let us say, repair expense on the depreciable asset. There is a specific section, section 14 to allow the deduction, and some can argue it is anyway incurred in the production of income under section 11. Can I claim the whole amount? Repair expense 100%. Or if you apply section 14, there is a maximum ceiling for you to claim. Can I ignore section 14 for repair expense? Can I claim the whole amount because anyway it is incurred in the production of income? No, that argument is not valid. Why? When you come to repair expense, you have to find out what is the most specific deduction. Yeah, that is you are allowing under section 11 all the expense incurred in the production of income, general. But the section 14 specifies the repair and improvements are deductible on depreciable asset. Therefore, repair expense on depreciable asset is concerned. Repair expense on depreciable asset is concerned. The section 14 is a specific provision, had to be followed. Therefore, the most specific deduction shall be applied even if that results in denial of a deduction. Even expense is refused, does not matter, more specific rule will be applicable. Okay. It is very important when you are reading this law, this rule have to be complied with or applied. Now, look at the question. As you know, application check 33. We have done application check up to 32, the last sessions. Look at the 33. The company which is engaged in business of manufacturing article has incurred the following expenditure during the year of FSMA 1920. So, question is whether these expenses are allowable or not due to the implication of section 10. Of course, we know we are not still discussed the whole total rules, allowable deduction only. With the discussion of section 10, we will see whether we can answer this question. The expenses to maintain a motor car used by CEO 1 million. The company has considered the monthly amount of 65,000 as his personal benefit in his employment income. So, this is basically the company incurred expense of 1 million rupees for CEO's motor vehicle. He is using the motor vehicle for official as well as private. Since the non-cash benefits are involved here in the hands of employee, according to the regulation issued by the Commission General, not only the vehicle, given the fuel also. So, I ascertained the regular amount to be taxable monthly is 65,000. So, then what 11? So, we are going to claim 1 million, but the 780,000 will be taxable in total in the hands of employee. So, the expenses up to the 780,000 cannot be a domestic expense as per the interpretation in section 197. So, the difference become domestic expenses by the company incurred 220,000 extra which has not been taxed in the hands of employee. So, then that coming within the definition of domestic expense. Even the regulation also clearly says anything you spended more than the amount taxable in the hands of employee, the excess shall be treated as domestic expenses. Okay. Payment of rent 1,200,000 to a landlord for an apartment given to a marketing director or marketing manager. The company has considered a sum of 45,000 per month as a benefit from employment income. The same rule will apply. The company incurred the expenses 1,200,000. The 45,000 into 12, the 540,000 is taxable in the hands of employee as rent benefit. So, the excess is 660,000. So, that become domestic expenses for tax purposes. Okay. The penal interest paid for outstanding overdraft facility obtained from a bank 230,000. Is it disallowable? No. Because what is disallowable is what? Any interest, penalty or fine paid to the government and subdivision of the political or subdivision of the government for breach of written law. But here it is not a breach of law, but it is not anyway paid to the government, so you are paid to the bank. No? So, basically business expenditure. You might be allowed under section 12, once you have done that one you see, it is not a so serious thing, it is not a violation. Because otherwise what happen? Basically when you are going to settle the overdraft, if you do not settle on time, there will be a penal interest on that. No? So, I am going to disallow that one? No, it does not come under that particular scope. Okay. That is a allowable deduction for tax. Surcharge paid on EPF. Yeah, that is, yes. EPF surcharge shall be disallowable under section 10(1)(b) item 3. Penalty paid to the inland revenue due to the delay in payment of nation building tax 110,000. That is again not allowable, but the payment of NPT would be a deductible expense for tax, no? Because it is not a prescribed tax only, the NPT amount. The NPT and financial service only identifies a prescribed tax as per the Gazette. That is for the bank and financial institutions. The normal NPT paid on a turnover 2% is become an income charged to the income statement. That is not prescribed tax or levy by the Commission General. That would be deductible as expense incurred in the production of income. But the penalty on the NPT is basically what? The breach of law. It it's payable to the government department. No, therefore it's a disallowable item. Interest paid of 25,000 includes dividend payable to the preference shareholder 8,500,000. The interests are allowable anyway, but normally interest payable to the preference shareholder under the accounting standard, you have to classify as interest, no. But though it's interest, it's a dividend by definition. Therefore, as you know, under section 10(1)(b), dividends are not allowable. So dividends shall be disallowed under section 10(1)(b). The cost incurred in providing food and beverages to the customers in a hotel, that's directly entertainment expenses that you can't claim for tax purposes. Okay. The provision of gratuity 6,300,000. You make a provision gratuity 6,300,000 during the year, but actual payment you charge to the gratuity account. So provision gratuity under the provision rule you can't claim, you have to disallow. But actual payment is a deductible expense for tax purposes 1,500,000. Okay. As an expense incurred in the production of income under section 11, we will discuss after this. The company has failed to deduct withholding tax at the date of 10% under section 84, the payment of rent 5,400,000. So then what do you do? Since you are not comply with the withholding tax provision under section 10 subsection 2, these items are not allowable deduction. The whole expense should be disallowed. The company has charged unrecoverable economic service charge 3 million. So it's a prescribed tax under the Gazette notification. Therefore, we have to go and add back. Okay. So now we will discuss the deduction rule. As I told you, deduction rule you can broadly divide into two categories: the main deduction rule and the specific deduction rules. The section 11 deals with the main deduction rule. Section 12 to section 19 deals with specific deduction rules. Look at the main deduction rule first. Section 11. Again, the section 11 main deduction rule, there are two components. The section 11 subsection 1 is to say all the expense incurred in the production of income from business or investment shall be deductible. But the subsection 2 says, section 11 subsection 2, the capital nature expense shall not be allowed. So if your expense of a capital nature you can't claim. So what you can claim is only revenue nature expenses, that is also you can claim if it is incurred in the production of income of business or investment. Okay. We will take one by one. Section 11 subsection 1. It's very important rule here. We will look at the most the expenses are going to be allowed under main deduction rule. Okay. Here we had this section in the previous act also, slightly different. Section 25, we call it section 25 general provision. Here they use the word main deduction rule. In calculating the person's income from business or investment for a year of assessment, the expenses to the extent that it is incurred during the year by the person and the production of income from the business or investment shall be deducted. So, according by analysis, there are three conditions to be satisfied to claim a deduction under this particular section. One is, what is allowable is an expense. If we compare this with the previous section or previous act, where the general rule is to say all the expense and outgoing both are allowable, but here the outgoing is not there. All expense could be deductible. So, expense, what do you mean by expense? Again, you have to go to interpretation section under 95. Expenditure or expense means the payment that made that reduces the assets of the person making the payment. Again, when you go to the payment, again defined very broad manner. No? Then the expense shall be incurred during the year for the deduction. Should be incurred. First thing, it should be expenditure. Number two, it should be incurred. What do you mean by incurred? So, as you know, when you come to business income calculation, you have to apply accrual basis. They go to section 23, subsection 1. Person incurred expenditure when it is payable. So, the amount is payable means it is incurred. The amount payable for the year of assessment 1920, but actually paid in 2020-21, which year you can claim? In the year in which it is payable, 1920. Similarly, expenditure payable in 1819, paid in 1920, which you claim? The year in which it is payable, 1819. So, do not go with the cash basis, you go with the accrual basis payable. Third rule is, it should be incurred in the production of income from business or investment. So, also you must keep in mind, when you come to deduction rule, certain expenses are deductible only against the business income, but certain expenses are deductible against the business income calculation as well as investment income calculation. Okay. So, you come to main deduction rule, any expense incurred in the production of income from business or investment. So, even the calculation of investment income like a rent income, royalty income, interest income, you can claim the expenses connected to that. Okay. If it is incurred in the production of income under section 11. So, what do you mean by incurred in the production of income? The same wording what we had in the previous act. It is very broad. There are so many case laws had to be discussed, they are in the syllabus. I would like to go through those cases and get updated yourself. Basically, I could say as a rough guideline, the expenses which are satisfied with the following requirements could be treated as expense incurred in the production of income. The expense which are incidental to the business. Incidental to the business, that means what? It is a normal thing for the business point of view. They will look at the nature of the business and see whether it is incidental to the business or not. For example, I could say the legal fees for land dispute. When come to property developing companies point of view, when they are buying so many lands in a year, their business is to buying and selling land or buying and developing the property improvement and selling the land. So, when you are buying so many blocks of land, there may be a dispute with regard to certain land in relation to ownership. We incur a legal expense on that. For that company point of view, that is incidental to the business, you see. But the manufacturing company which have bought a land for to construct the factory, if you incur legal expense for a dispute on the land, that may not be incidental to the business, you see. Something like that. You have to look at the business point of view whether it is incidental to the business or not. Then when you are going to elevate the deduction, you have to also understand the nature of the business, very important, to understand whether it is incurred the production of income or not. Okay. The expenses incurred for direct purpose of earning the profit. All the production related expenses, marketing expenses are for revenue generation purposes. It is incurred in the production of income. The expenses which are closely connected to the business but not remotely connected, normally could be said they are incurred in the production of income. It is not enough for you to say the expenses connected to the business, that is not enough. Because when you say incurred in the production of income, so different from the UK law, it is very narrowly defined, not broader. Not expense for the purpose of trade. The expense incurred in the production of income, very narrow. They should be very closely connected, not remotely connection. Okay. There are so many case laws are there. In your syllabus also there. I would like you to please go through the cases in relation to the expense incurred in the production of income. Okay. They don't think, some layman I have seen, they think this way. Under section 11, for you to claim, the expense to be incurred to generate the revenue, nothing like that. It is not meant here. The incurred in the production of income does not mean there should be a revenue for to claim the expenses, no. There need not to be corresponding revenue. We have a Valambrosa case. Maintaining immature area, where there is no revenue generation in that area, but still the court allowed in UK law, it is a deductible expense. Now remember, the incurred in the production of income does not mean there must be a revenue to claim the expense. It should be purely a business nature expense, that is enough. The business should have been commenced, that is all. Should be business should have been commenced. You can't claim the expense before commencement of the business. That is not incurred the production of income. Once you commence the business, you generate the revenue, but the revenue generation is not a deciding criteria to claim the expense. It is very important. Okay. Sometimes I may incur expense during the current year, but revenue I may generate the next year. But that does not mean that I can't claim. No, I must be able to claim. Okay. Look at the question. The following expense incurred by the company which is engaged in provision of management consulting services fall within the meaning of expense incurred in the production of income. The employee remuneration including bonus, yes. The remuneration is an expense incurred in the production of income, you can claim. Charity and donation, so nothing to do with the business, no. So, good example, it is not incurred in the production of income, so you can't claim. It is not disallowable because under section 10, because section 10 nothing is there for to say charity and donation to be disallowed, no. But you can't claim this expense, why? Because there is no permitted deduction under the law. no specific rule to claim the charity donation, even it does not come under general deduction rule also. There is no express provision for you to claim. They have as per section 10, subsection 3, you can claim this particular expense. Gift and compliments, same. Which are not incurred in the production of income. In the absence of the specific deduction or general deduction rule, you can't claim. Advertisements, no specific rule, but it's incurred in the production of income, you can claim. It's a business nature expense. Of course, this is a donation is a the advertisement is a specific, basically for revenue generation, no, to promote the sales. It's incurred in the production of income. Foreign travelling for business purposes, not in the previous act, there was a deduction, the previous act, some part has to be disallowed, but the current act, the law is silent, you can claim foreign travelling, business purposes as an expense incurred in the production of income, okay, under main deduction rule. Having said that, the expense incurred in the production of income from business or investments are deductible under subsection 1 of section 11. The section 11 subsection 2 provides, but if the expense is a capital nature, you can't claim, shall not be allowed. Therefore, capital nature, you don't allow it as an expense incurred in the production of income. Because as a capital nature expense is concerned, the subsection 2 is a specific. All the capital nature expense should be a disallowable item. It's a basic principle in tax, as you know. What is taxable is a income, not capital, unless the law provides for you to tax the capital, like a capital gain, the current act, realization of investment asset. Otherwise, if law is specifically not mentioned for taxing the capital receipts, under normal rule, capital cannot be taxed, it's outside the scope of income, liable for tax. If the capital is not taxable as a source, the expenses of a capital nature also you can't claim. It's not a law in Sri Lanka, it's a universal principle, worldwide principle of tax principle. The question of what do you mean by capital expenditure? It's a very broad concept. There are so many cases are built up, not in Sri Lanka, in international also, not only in Sri Lanka, international also. But our section 11 subsection 2 defined as a inclusive definition, not exhaustive definition, that is very important. If you say exhaustive definition, you have to forget about the lot of cases. We are confined to the idea only on this, but the definition inclusive. What do you mean by inclusive? Apart from the normal definition in principle, capital nature expenses, that also includes expense that require a benefit capable of lasting longer than 12 months. So, any expenses, the benefit of which lasts more than 12 months, normally we call enduring benefit. The expense results in enduring benefit to the business, then that expense become capital nature expenses, you can't claim for tax. Okay? It's a very important rule. It's a very popular definition this. That has been done as an inclusive definition. Okay? Since this is defined as an inclusive definition, the relevant cases are also important. So many criteria are there for this case loss. The Valambrosa Rubber Company versus Farmer, it says the routing expenses like weeding etc. in an immature plantation is not a capital nature expense. Atherton versus British Instrument Hurlsby Cables Limited, again the principle is what? Enduring benefit test. The expense results in enduring benefit to the business. There is creation of asset within the business, fund within the business. It's a capital nature cost. Theobald versus Commission of Income Tax, same rule. Associated Motor Cement Manufacturing Company, expense which are resulted in enduring benefit again. Horton Tea Company and Law Shipping case and Odeon Theatres, one principle where cumulative repair can be deductible. The normal repair is a revenue in nature, by accumulated repair incurred due to the neglect of the previous owner is a cumulative repair. It is a capital cost. It is a part of capital, part of purchase consideration. Therefore, you can claim that expense. So, I would like you to please go through the relevant cases in detail in your study pack and update yourself on this very important area. Okay. Question 35, to see whether there is capital nature expense or not. A company which is engaged in business of manufacturing has an expense incurred in 2019-20. You got to clarify whether this is a capital nature expense or not. Secondly, whether it is allowable for deduction for tax purposes. The legal fees paid in relation to dispute on the title of the land purchased to construct a factory building. So, this legal fees is incurred for enduring benefit. There is a capital nature expenses, you can't claim. Okay. For this companies, for enduring benefit. Maybe some can argue it is incurred the production of income because to buy the land, to protect the land, but capital nature for long term benefit to protect the land. The benefit of the expenses lasts for more than 12 months. Therefore, it is a capital nature expenses that you can't claim for tax. Okay. The legal fees paid for LT case, labour tribunal case. This is not a capital nature. Day to day matters. It is a revenue in nature. So, just because of revenue in nature you can't claim, it should be incurred in the production of income. Yeah, it's obviously is incurred in the production of income. Why? You can't link with the revenue sales on this, but to continue the business, you must handle the legal issues on the labor issues. So, it's important for you to continue the business. So, there is incidental to the business in a factory. If you have a more number of employees, the LT cases are normal thing, it's incidental to the business. As it is incidental to the business, it's incurred in the production of income, you see. Legal fees paid to purchase of a block of land, again enduring benefit, capital nature expense, not allowable. The expense related to the share issue. So, this expense is incurred to raise short term or long term financing. Yeah, share is a long term finance. So, once you raise the share capital, the company's benefit is for long term, that accrue the benefit for long term. There this expense also incurred to raise the long term capital. The benefit of the expenses lasts for more than 12 months. Therefore, under enduring benefit test is a capital nature expense, should be disallowable item under section 11 subsection 2. The exchange loss arises on the import and settlement of raw materials. The exchange loss, the current law is silent about the exchange gain or exchange loss again to a certain extent, but here is a raw material purchases, no, it is a part of the purchase cost you can claim as expense incurred the production of income. Right, now we have done the main deduction rules, very important rule here, please remember that. It has two subsections. Section 11 subsection 1 says all the expenses incurred in the production of income you can deduct to generate relation to business or investment. The subsection 2 says, but if the expense is of capital nature, it can't be claimed. Okay. Now, we will come to specific deduction rules. So, look at the section 12, specific deduction rule for interest. Section 13, specific deduction rule for allowance for trading stock. Section 14, specific deduction rule for deducting repair and improvements. Section 15, specific deduction rule for research and development as well as agriculture startup expenses. Section 16, specific rule for capital allowance and balancing allowance. Section 17, again specific rule for loss on realization of assets and liability of the business. Section 18, the excess interest cost under the capitalization rule will apply. Section 19, the business loss claim and the investment loss claim. Likewise, the section 12 to section 19 deals with certain item of the expenses only, where it does not apply the main deduction rule. The main deduction rules are, if the specific deduction are silent, specific rules are silent only, you must apply the main deduction rule. Because as we discussed section 10 subsection 3, if you do different section contradictory, you must always apply the specific rule. Having specific rule, you can't supersede that and apply the general rule. Okay, it's a law of interpretation or rule of interpretation. Now I'll take one by one the specific deduction rules. Section 12 about the interest expense. Good thing. Not like a previous act. The previous act very simple, all the interest paid or payable are deductible. But the current act very specific about the interest claim. You require a purpose of loan. The interest cost incurred for loan obtained for what purposes? You will decide before eliminating the interest cost. It is so the purpose of section 11. I think this is a clarity for section 11. That means interest cost could be deemed to be incurred in the production of income if it coming under criteria of section 12. So, interest incurred by a company or by a person for a year of investment under a debt obligation shall be deemed to be incurred in the production of income to the extent that the debt obligation was incurred in borrowing money that is used during the year or was used to acquire an asset that is used during the year in the production of income. I mean, for example, when you debt obligation, let us say loan, if you incur interest on the loan, loan is obtained to acquire an asset either in the current year or in the previous year, but the asset should be put into use for the production of income. That is very important. The loan is obtained to acquire an asset, the asset is used in the business purposes, then relevant interest on the loan you can claim as incurred in the production of income. Okay. But if you are not acquire asset using a loan, then the loan should have been used for the business purposes, the production of income. So, basically the working capital loans, overdraft, no, short term loan, not to acquire assets, other loans, import loans, so many loan category we have. If you are a business purpose only you can claim. There one thing is very clear, the section 12 specifies you to claim the interest only for business purposes only, nothing else. Under A, you must be able to show asset which was bought using a borrowing. B, you must also mention borrowing is used for business purposes. Then only that interest cost you can claim for tax purposes. Okay. Look at the question 36. The question whether the following interest expenses incurred by the company are deductible for the year of FASMA 1920. Interest paid on a loan obtained during the year 1718 to construct a factory building. The building is used during the year 1920 in its production. It is very clear, you can allow under section 12. Why? Because the borrowing is used to acquire the asset in 1718. An asset is put into use during 1920, the production of income. So, the asset is in usable condition and it is used in the business purposes. The relevant interest will be deductible for tax. The interest paid on the loan obtained during the year to purchase a machinery. The previous one was loan obtained in 1718, but now current year. Again allowed under section 12, provided the loan is used to acquire the asset, yes, done. The asset is used during the year in the production of income. The question comes, the asset is used during the year, the machinery. If used, you can claim. If not used, you can't claim. So, I am allowing on the basis it is used during the year, the production of income. Interest paid on overdraft facility. It's not, we are not acquire the asset. Coming under B, the overdraft is used for the production of income for business purposes. Let us say for a settle the creditors to buy the raw materials, no, settling the creditors for any of the working capital requirements. Business purpose you are used, so interest you can claim for tax purposes. Here the slightly difference, interest paid to construct a showroom, but the construction is not yet completed by 31st March 2020. So, what I am trying to say is here, you construct the building, but the building is not yet used in the production of income, then you can't claim. So, not allowed under section 12, because the asset is not used during the year in the production of income. But there won't be a loss to the taxpayer here, because you know why? Under accounting standard, this particular borrowing cost, you can't charge to the income statement, you have to capitalize to the asset, no, because it's a qualifying asset. So, if you capitalize to the carrying value of the asset, finally you can claim capital allowances along with this particular capitalized interest. There you are not losing, finally you can claim the form of capital allowances. But technically this interest you can't claim under section 12. Okay. Interest paid on a loan obtained to finance the payment of buyback of shares. This is one of the classic example, according to my understanding. It is not covered under section 12. Why? Because the buyback of share is not for the business purposes, no. It is not used, the loan is not used in the production of income. Therefore, it is a good example, this interest is outside the scope of section 12. That is not incurred the production of income, you can't claim. Okay. They have given here The first three are allowable, the fourth one not allowable as interest, but you can claim in the form of capital advances by capitalization. But fifth one, I cited the example, the interest which are not covered under section 12. Then look at the section 13, the allowance for trading stock. What is this whole thing about? Nothing else, basically is a cost of sales. We never look at the allowability of the cost of sales. No, why? The cost of sales is 100% used for the revenue generation in the production of income. But our current act prescribe what cost of sales should be deductible as allowance for trading stock. The method of calculation also prescribed in the law under section 13. Sometimes section 30 would have been relevant as specific rule, maybe in relation to the calculation. So, trading stock, what do you mean by trading stock? We discuss under section 6. Any consideration received in respect of trading stock should be included in calculating the business income. The revenue you take into the calculation, the corresponding expenses you can claim under section 13. So, what do you mean by trading stock? It is a composite of finished goods, work in progress, raw materials and other consumables. No? For manufacturing companies, trading stock might comprise of claimability of the finished goods coming under cost of sales, part of raw material consumptions, work in progress transferred, etc. But for a trading business, the cost of sales mainly comprise of finished goods, trading stock or finished goods stocks. Nevertheless, depending on the nature of the business, the trading stock, whether it is a finished goods or composite, the raw material and the work in progress, what are the amount used during the year can be deductible for tax purposes. How do you calculate? You take the opening value of trading stock, opening balance, plus expense incurred during the year in the cost of trading stock. We will clarify that one under section 42, I believe. Then claim minus closing value of the trading stock. So, opening stock plus purchases, cost incurred minus closing stock. That is normal calculation of the cost of sales. No, it is like accounting, like accounting standard. So, go to the section says again, how do you value the closing stock? It should be lower of cost of market value. Like in our accounting standard also, the valuation is same basis. No, normally cost is less, so you normally value at cost. But wherever the market value or realizable value is less than the cost, you must reset to the market value, write down to the market value. So, valuation should be based on the market value. Say example, calculate the allowance for trading stock for the year of 1920 based on the following information. The company's value of stock as at 31st March 2019 and 31st March 2020 are 80,500,000 and 97,600,000 respectively. So, cost of purchase of stocks during the year 1920 is 450 million. And I will little bit complicated. The company has charged a sum of 20,500,000 as an inventory written off during the year. This amount of inventory was included in the value of the opening stock. So, when you are writing off to the P&L account, debit to the P&L account, charge writing off, where you credit either to the purchase or opening stock. They decided coming from the opening stock value, credited to the opening stock and debited to the P&L account. Here either we take opening stock including this, then you do not charge it again, then there will be duplication. So, that is the answer. Yeah, the allowance of trading stock will be the opening stock plus cost of trading stock during the year minus closing balance. The opening stock 80,500,000 plus cost incurred in the year 450 million minus closing stock 97,600,000. So, equal to 432,900,000 is my allowance for trading stock, which are deductible under section 13 of the Revenue Act. What about the write-off value? Can you claim? No. If you are going to claim write-off, there will be a duplication. Why? The write-off is already included in 80,500,000. But we are not taken into account. If 80,500,000 is after removing the opening stock written off, then you must claim the write-off. But generally, opening stock is with the amount, original value. I am not going to claim again. So, you cancel out the write-off and claim the opening stock. The impact is same. Okay. The cost of trading stock clarified under section 42. In determining the cost of trading stock of a business, no amount shall be deducted in respect of repair, improvement or depreciation of the depreciable asset. This expense should not be charged as a cost of trading stock in valuation. Only you have to apply the absorption cost method, in contrast contradictory to marginal costing method. No? So, you would have learned in this costing also or management accounting, there are two methods of valuation, marginal cost or absorption cost. What is the difference? When you come to marginal cost, you include only direct material, direct labor and other direct overheads or direct cost. But absorption costing method means apart from the direct cost, you charge overhead also, especially factory overheads. No? So, the valuation should be with the factory overheads, charge to the cost. You include in your manufacturing company, you charge to the cost of production. The obvious valuation should be based on that, absorption costing. How do you value? Yeah, the owner should elect for the cost of asset to be determined according to the FIFO weighted average method. The first in first out method of weighted average method. That is also recommended under the account standard. But whatever the method you chosen, you must apply continuously. But if you want to change, you must get a written permission from the Commission General. But account standard, I believe, if you change the method, you must disclose in the financial statements with the impact. But apart from that, for financial reporting, under New Inland Revenue Act, you must communicate the fact to the Commission General in writing. Okay? Remember that. Law defines what is meant by absorption cost method. Means the general accepted accounting principle under which the cost of trading stock is the sum of direct cost, direct asset cost, direct labor cost and direct factory overhead cost. Average cost method means the general accepted accounting principle under which costs are allocated to fungible assets of a particular type owned by a person based on the weighted average cost of the assets of that type owned by the person. The direct labor cost means the expenditure incurred by a person on direct labor, that directly relates to the production of trading stock. Direct asset cost means the expenditure incurred by a person in acquiring any asset or assets that constitutes trading stock or become an integral part of the trading stock purchase. Factory overhead cost means all the expenditure incurred by a person in producing trading stock except direct labor and direct cost, asset cost. The first in first out method also means generally accepted accounting principle under which costs are allocated to a fungible assets of a particular type owned by a person based on the assumption that assets of that type owned by the person are realized in the order of realization. You issue first in first out basis.